All right. So this is very exciting for me to do today. It's been a while since I've been on live stream, been on vacation for a while. But anyway, welcome to another public live stream session. And man, am I super fired up to talk about how these new tax changes from the big, beautiful bill will impact your finances in 2025. And we've got a lot to talk about today, from Social Security, HSA, overtime tips, salt deduction, first pension, child tax credit, and many more. And I'll have some Q&As throughout this live stream, so be sure to post your questions in the live chat below. And I'm going to make dedicated videos for each topic in the future, so be sure to subscribe if you haven't done that already. And I'll also leave chapters in this live stream for those who would prefer to watch this on replay, but I will do that after the live stream is over. Anyway, I really appreciate all of you tuning into my live stream, which happens every other Wednesday. And I want to take this opportunity to offer you free resources on my website at firesection.com/resources, including the net worth calculator, compound interest calculator right on the website, and the financial independence calculator. And if you want to join my other private client, like private clients or private client program, let me show you this. And oh, I'm sorry. If you want to join my the other private clients and so that you can achieve your financial independence number, you can join my program by visiting firesection.com/private clients. It's like a little brain just stopped working there for a second. But before joining my private client program, you have to do a 60-minute consultation first, and you can schedule that on my website as well. And just for the people watching this on live stream, you can get 20% off on our Fire Investing Academy and the private community, just like this one that you can see, by using a coupon code. It's going to be Fire Livestream, and just use that coupon code at firesearcher.com/pricing. So with that said, let's get right into it. And I gotta pack and get ready to go to Alaska on a cruise. So if you've been on an Alaskan cruise, let me know, how was your experience? Would you do it again? But anyway, the first one that I'm going to go over is actually, and I'm going to pull up the bill throughout this live stream here so you can see it. But the first one is going to be the standard deduction. So we started 2025 knowing the standard deduction. If you've been following me for a while, the single standard deduction was $15,000, but now it's $15,750. And the head of household has also increased from $22,500 to $23,625. And married, filing your taxes jointly, that's going to be from $30,000 to $31,500. So they're still going to be adjusted for inflation annually. And the big beautiful bill is going to have the standard deduction staying there permanently, right? So it was expiring in 2025, but now it's going to be extended until the end of 2028. So what does the standard deduction mean? Just real quick, because I want you to understand this before I go any further in the live stream, because a lot has to do with the standard deductions, even with the SALT deduction I'm going to talk about, and as well as the Social Security deduction and all that. So that's something that I want you to really understand, okay? So if you're a single guy, or girl, your first $15,750, I'm going to change my color to red here. So $15,750, that's going to be your tax-free money. So if your adjusted gross income is $80K this year, minus $15,750, right? So, okay, there we go. It solves it for me. So 15, that's weird. That's not even the right math, but let's do this again. 80,000 minus 15,750. There we go. This is your AGI. That will be your adjusted gross income, and this is your standard deduction. And this is going to be what's called a taxable income. Okay, so this is the finance 101 that we all kind of didn't really pay attention to, but this is your gross income that you get, and then your standard deduction of 15,750, and then that answer just disappeared. But no, we just went over that. And the same thing, if you're a head of household, if you got a kid at home, if you're married, filing taxes jointly, this is going to be $31,500. And most people choose standard deduction over itemized deductions over the past, well, since 2017. So for the past 8 years. With the SALT deduction, however, being increased to 40,000, itemized deductions are becoming more attractive now, but it really depends on your finances. And I'm going to go over that later on in the live stream. But that's what it means with a standard deduction. So if you didn't take any notes on it, if you're single, 15,750. Head of household, it's going to be 23,625. And if you're married, filing taxes jointly, it's going to be 31,500. So your first 31,500 is tax-free, and that's what it means with a standard deduction. Okay, now, which leads to the next one, and let me go to page 218 here. So, Social Security deduction, and this is something that the Trump administration or President Trump promised during the campaign trail was to eliminate Social Security tax, but the reality is that it did not make it there. So the solution that the Senate and the House did was to increase the standard deduction to add additional deductions for people over the age of 65. So if you collect Social Security at the age of 62, you're not going to enjoy these senior deductions, is what we're going to call. Okay. So please keep that in mind. It's not about when you collect Social Security benefits, it's about your age. So I'm going to say this again. So the legislation did not eliminate federal income tax on Social Security benefits. So we just got a $6,000 senior bonus instead. And I'm going to show you some examples here so you understand how this works. So right here. All right. So I'm going to give you an example. So let's say you are, let me go to the single one. Let's say you're a single guy or gal, right? And you just retire at the age of 67 and you start collecting the full Social Security benefit, and your total adjusted gross income is $60,000. Okay, so that's actually pretty realistic scenario. So the new senior deduction is $6,000. Okay, and the standard deduction that I just talked about is $15,750. And then there's the senior bonus for being over the age of 65 is $2,000. Okay. So last year was 1,950. So there's always been a senior bonus once you reach 65. So you would have 15,750, and then you have an additional $2,000. And what was written in the bill was this as $6,000. Okay. So $2,000, and if you're legally blind, you can get another $2,000. But I'm not going to include that in this calculation. So the total deductions for this scenario is actually going to be $17,750, and then your taxable income, if you subtract $17,750 from $60,000, your taxable income is going to be $36,250. So you're still going to get taxed, kind of like, for the progressive tax system. So the first 10%, the 10% will be taxed on the first $11,975. Okay. So your total tax for this first bracket is $1,197. And then the next bracket is going to be 12%. And that's going to be the next $24,275 out of the $36,000. Okay. The most common misconception is that people think that they're going to get taxed on the entire 60,000. That is not correct. And if you want to calculate your taxable income after deducting the standard deduction and the senior deduction, and as well as the senior bonus. So the second bracket is you're going to owe $2,913. So if you combine those two together, the total taxes owed is going to be $4,110. So how much does the new bill, the big beautiful bill, saves you? It's about $720, assuming that your marginal tax rate is at 12%, right? It's not a tax credit. There's the difference between tax credit and tax deduction. I'll explain that later on. So if you're at 22%, obviously you're going to save more. And let's say you go to 24, 32, 35, but you're most likely not going to be in the 32, 35 because there's an income cap on that. or there's the income phase out range, and I'm going to show you that later on. But you're going to end up saving more taxes if your marginal tax rate is higher. And if you're married, let's say you're both 67 and your combined adjusted gross income is $100,000. Okay. Now, let's say the husband is 65 plus and gets the senior deduction at 6,000, and the wife also gets the 6,000, and then the husband's senior bonus is 1,600, and the wife's senior bonus is 1,600. It's different from the single, right? And the married filing taxes jointly standard deduction is 31,500. So the total deduction is going to be 46,700. So taxable income after subtracting the total deductions from the AGI is going to be $53,300. So the taxes, again, the first 23,200 is going to be taxed at 10%. So this is the tax that you're going to owe. And the next bracket is going to be the next 30,100 out of the 53,300. And this is how much you're going to owe. So the total tax is going to be $5,932. And the total tax savings is going to be $1,440, which is double the amount from the single person. So I hope this scenario makes sense to you. Okay. Now, income phase out range. So the income phase out range is, it's hard to read on the bill. If you straight up just look at a PDF, this is, this is the bill, right? So I'm going to dumb it down for you. So if you're single, making $75,000 a year, then you're fine. You're going to get that bonus of $6,000. Okay. But the phase out does begin at 7,500. Okay. And then it ends at 175,000. So which means that you cannot get that $6,000 once your income reaches 175,000 as a single individual. And the phase out begins at 75,000. Now I'm going to show you the calculation in a little bit. So that's a difference of $100,000. Okay. So that's something that you do want to remember when you calculate your retirement number or your income phase out range, is what is the difference between 75,000 and 175,000? It's $100,000. All right. So if you're married filing taxes jointly, you can get that $6,000. Wrong pen here. You get that $6,000 if you make less than $150,000. And the phase out begins between $150,000 and $250,000. Okay. And also the difference of $100,000. All right. So I'm going to walk you through the phase out calculation now. So if you need to rewind back and watch it again, just feel free. All right. So if you're single and you're making $100,000, which means that you are $25,000 into the phase out range, because remember the limit was 75,000. So what you want to do is you want to calculate 25,000 divided by 100,000, because that was the difference, right? Difference of $100,000. So 25,000 divided by 100,000, that's going to give you 25%. So the senior deduction is going to be 6,000. So you want to multiply that by 25%. Okay, right? And that's going to give you $1,500. So 1,500 is what you want to subtract from 6,000. So the maximum that you can get out of that senior deduction is $4,500, because you are $25,000 into the phase out range. Does that make sense? Okay. Now I'm going to give you another scenario. Let's say you are married, filing taxes jointly, and you're both making $200,000, and you're both over the age of 65. So you are $50,000 into the phase out range. So since you're $50,000 into the phase out range, because the maximum is $150,000 to collect the maximum deduction. So you want to do 50,000 divided by $100,000. Remember the difference, right? And that's going to be 50% phase out. So between the husband and wife, you can get $12,000 total, 6,000 each. But you want to multiply that by 50%. So the maximum that you can collect is $6,000 if you're making $200,000 and modify just the gross income. I hope this calculation makes sense. If not, feel free to just rewind back. Let me see here. Okay. Let's give some membership here. And there we go. Let's see how that works. All right, cool. But yeah, again, that I know this is kind of like complicated, but I just want to pause for a second and give out the membership gifts. But if you want to join my private client program, which is the private community, just go to firesuch.com/community, and we got a pretty big one there, and they get all the insights over there. Anyway, okay. I hope that makes sense. And next one I want to go over. What is the next one? All right, let's go over the overtime pay. So the overtime pay is something that people are misunderstanding hugely because it's not the whole thing that you can deduct. So people think that you can write off the entire overtime amount, and that's unfortunately not the case. Um, to be fair, Congress can't really afford it anyway. So, excuse me. So no taxes on overtime. It started on January 1st, 2025, right? So the bill passed on July 4th, but you can go all the way back to January 1st, 2025, and then it's going to end on December 31st, 2028. So this is an above the line deduction. So you get to save more on top of the standard deduction. So you don't have to itemize your deductions. Okay. So if you're married, filing taxes jointly, and you're getting that 31,500, and you have another $5,000 in overtime, that's going to be 36,500. Does that make sense? Okay. So, but you won't see an immediate paycheck change because your employers will still withhold federal taxes from overtime throughout 2025. And when you file your taxes in 2026, you're going to see some tax refund if you worked any qualified overtime. Okay, now I'll talk about the tips later on. And you can deduct. So, oh, you know what? Let me not jump ahead here. Let me go to 257. Okay, so if you want to read the bill, you can on your own, but it is on page 257. So, let me break this down for you real quick. All right. Forgot to share the screen here. All right, here we go. All right. And so overtime, you can deduct up to 12,500 in 2025 if you're single, or $25,000 if you're married filing jointly. And it's the difference of your regular pay versus overtime pay. Okay. So I'm going to give you this example. Let's say you're making $30 an hour, right? That's your regular pay right there. And your overtime pay with a time and a half is going to be $45 an hour. So no taxes on overtime is actually the difference of $15 an hour, not the whole $45 an hour. And I've seen several comments on YouTube or other social media pages saying that, oh, you get no taxes on the whole overtime. And that's not the case at all. You actually only get a tax break on the differences between overtime pay and the regular pay. Okay. So you work 60 hours in 1 week. And let's say you got 40 hours, that's your regular hours. And you multiply that by $30 an hour, and that's going to give you $1,200, right? And in the same week, you pull 20 hours of overtime, and that pays you $45, and that gives you $900, right? So $45 an hour, that gives you $900 total. Now, the tax break, again, is going to be the difference of 30 and 45. So you don't get taxed on the $15 an hour. So if you don't get any overtime differential because you're in a job that is let's say you get paid well, or if it's in your contract that says that you do not get that overtime rate, then you're poop out of luck. All right. So $15 multiplied by 20 hours. So the tax break is actually $300, not $900. Okay. And feel free to put any questions in the live chat. I know this is being live streamed to the private membership group too. So I'll be getting those DMs in a little bit, and I'll answer some of those questions later on. But again, you get a tax break on $300, not $900. All right. So that is the difference. Anyway, I hope that makes sense. And I know there are a lot of comments saying that, you get a whole tax break. That's not the case at all. And also remember, you don't owe any federal income tax on that $300, but you still have to pay the state income tax. You still have to pay the Social Security and Medicare. Okay. Now, let's talk about the income phase out. So the income phase out range is pretty interesting. If I just say it's $100, decrease by $100 for every $1,000, you're going to be like, I don't even know what that means, right? So let me just explain it to you. So let's say you are single. Well, you know what? Let's say you're single, right? So the phase out begins at $150,000. That is the modified adjusted gross income. That's when the phase out begins. So you don't get any overtime deduction if you make over 275,000. So that is a difference of 125,000. So this is the critical number that you need to remember or know. And what is the difference between no deduction, which is 275,000, and the maximum deduction at 150,000, right? So if you make $200,000 a year and you are $50,000 into the phase out range, right? So you're over it. So 50,000 divided by 125,000, which is the difference, that gives you 40%. So that means that you're going to lose 40% of that deduction. So that 12,500 as a single person, that is the maximum that you can deduct for overtime. You're going to lose 5,000. So you subtract 5,000 from 12,500. This is the maximum that you can deduct from overtime, what's called a prorated deduction, because you are making $200,000 or $50,000 into the income phase out range. If you try to Google search any of that, nobody really explains it very well. Or even on the website, any news articles, they don't really explain that. But feel free to just replay that if you need to. All right. So if you're married, let's say you are married, the phase out range begins at $300,000 in modified adjusted gross income. So there will be no deduction at $550,000. So there's a difference of $250,000. So if you're married and filing your taxes jointly, you got a really good tax deduction going on here, right? So let me give you an example. Let's say you make $400,000 a year, great income, but you are $100,000 into the phase out range, right? Because you are the maximum is $300,000. So you want to do 100,000 divided by 250,000, which is the difference, and that gives you 40%. Again, you're going to lose 40% of the total deduction that you could get, which is 25,000 if you're married. And so you want to subtract 10,000 from 25,000, and that gives you 15,000 as the maximum that you can deduct for overtime. Does that make sense? Okay. So that's how you calculate your income phase out range for overtime pay. So the amount you can deduct will be reduced by $100 for each $1,000 you exceed in that income threshold. So if you're a single person, again, you only have a difference of 125,000. So you don't have a whole lot of wiggle room, so to speak. So, but as a married couple, you can double that. So 250,000. So pay attention to your pay stub if you haven't started already, and show the regular hours you worked and that overtime hours that you worked. So again, the employers will still withhold your taxes throughout 2025 because they weren't ready for that, right? So you're probably not going to, you're going to get the tax return in 2026 unless you want to manually adjust your W-4 tax withholding. That's up to you. But just something that you want to pay attention to, and make sure to write down how many overtime hours you've done, right? You want to make sure that your record is clean and correct when you signed your time card, that kind of thing. You want to have, I did this many, overtime hours, stuff like that. But yeah, and if you're like, let's say you're a single firefighter earning a $75,000 base salary with, let's say, $15,000 from overtime. Now, I know those guys work overtime. You only pay taxes on that $2,500 that you went over. I hope that makes sense. Okay. So that's, overtime, unfortunately, it's not the whole thing. Originally, they had in the House bill was to deduct the entire thing. And the Senate or somebody in the House was like, well, hold on. Let's not do that because the tax revenue they were going to get pretty screwed. But anyway, the next one I'm going to go over is the no taxes on tips. So if you go to page 247 of the bill, And this is where it's going to have all the no taxes on tips going on. Okay. If you want to read that on your own, it's completely up to you. But no taxes on tips. Again, it started on January 1st, 2025, and it's going to end on December 31st, 2028. And it's up to $25,000 instead of the 12,500 with overtime. This one is 25,000, whether you're single or married. So a qualified tip under section 70201 means that it is to be paid voluntarily without any consequences in the event of non-payment. So what that means is that it has to be a voluntary payment from the consumer. And you know how you go to a restaurant and they charge you a mandatory 15% charge on tips because you had a group of 10 people or more, right? Employees will not be able to deduct their taxes from those mandatory tips because they're not considered qualified tips. And I hate it when restaurants do this mandatory tip crap because it defeats the purpose of tipping the workers, right? But anyway, different subject. And these businesses, they, some restaurants, I wouldn't say all of them, they do force consumers to tip because it was a large party. And I've seen a lot of this in Vegas as well. But anyway, so to qualify for the tax deduction, the tips have to be received by consumers engaged in an occupation that receives tips on a regular basis before 2024. So this is designed for people in the hospitality and service industries. The Treasury Secretary is supposed to publish a list of qualifying occupations within 90 days of signing the bill. That was from July 4th. So we should see the list of qualifying occupations from the IRS by October 1st. And I'll post that in the private membership group as soon as it comes out. So in my industry, which is considered to be the finance or professional services industry, right? Or the sector. I don't ask you to tip by service when I, give you a 60-minute consultation when you go to firesession.com/consultation. And this is to prevent people from trying to dodge taxes illegally. And if you're an employer in an industry that doesn't ask people to tip, then you should not change how your pay is structured because that would be illegal and extremely shady. So don't do that. And there's some misinformation out there about what's considered a qualified tip. The original bill from the House bill, if you've been following me for a while, it only said the cash tips. And that made me raise my eyebrow. I'm like, seriously? Most people probably don't even claim or put their cash tips on the tax form or file it with their employers. But they changed that to any tips from cash tips, credit card, or debit card tips, tip sharing, or non-cash tips like gifts. So if you receive $20 or more in tips per month, then you're required to report them to your employer. Do most people report their cash tips? I'll let you answer that question on your own. And your employer will still hold federal income tax on your tips. So you won't get the tax savings until you get your tax return in 2026. And again, this is a above the line deduction, just like the overtime pay. So you get to save more on top of the standard deduction. And let me give you some examples of the income phase out range just for the tips. Okay. So tax breaks decrease by $100 for every $1,000 you're above the income limit. And it's the same as the overtime rule, but you get that $25,000 tax exemption regardless of your marital status. But the income phase out range is different because between single and married filing taxes jointly, right? So for single, phase out at $150,000 right there, okay? So in modified adjusted gross income, no tip deduction after earning 275,000. Is it realistic? Yeah, I have seen some high-end restaurant workers in Vegas making really good money. I mean, if you go to any like the Wynn or Caesars and you go to this high-end restaurant, they really take care of you. Their base salary is really high and they make a lot of money from tips, right? And anyway, but this is the difference of $125,000, right? So if you make 175,000, and which is 25,000 into the phase out range of 150,000. So if you do 25,000 divided by 125,000, that gives you 20%. So you have to remove 5,000 or 20% of that total deduction. And so the most that you can deduct is $20,000 or what we call the prorated deduction for tips because you make $25,000 more than the maximum income deduction there at 150,000. Okay. Now, if you're married, your income phase out range begins at $300,000. So the no tip deduction will be after 550,000. So that's that's crazy, but 550,000. But that's the difference of 250,000, right? So the example, let's say you make $350,000 in income, and you want to subtract that, and the you're $50,000 into the income phase out range. So that gives you 20%, right? So 20% of 25,000 is 5,000. So you're gonna miss out $5,000 from the total deduction that you could collect because you're $50,000 into the income phase out range. So that gives you $20,000 in prorated deduction. I hope that makes sense. Okay. So that's how you calculate the income phase out range for tips. So again, tips, $25,000 for a single or married head of household, doesn't matter. Overtime, the 12,500 for single head of household and 25,000 for married couples. And you work at a restaurant making $40,000 a year, and let's say with $10,000 in qualified tips, then you don't pay federal income tax on the $10,000 tips, but you'll still pay state income tax and payroll tax and like Social Security and Medicare. And Tax Policy Center found that households making less than $33,000 would not benefit much because they don't pay that much on federal income tax anyway with the standard deduction. So that's about 40% of US households that report tip income that would not benefit from any tax breaks from the big beautiful bill. But the other 60% will benefit, and their tax bills will drop by an average of $1,800 a year. And it's going to benefit the middle income households more than the lower income household because the middle income households pay more taxes than they do. Okay. I hope that makes sense. Yeah, I'll talk about the HSA in a little bit, Aaron. That's a good question too. I will touch on the HSA. Okay. The next one I'm going to go over, and this is another popular one, that is the car loan interest. So the provision is between 2025 and 2028. So you have to purchase a brand new vehicle. And let me go to that page number real quick. It is 263. No tax on car loan interest. Okay. So you have to purchase a brand new vehicle, brand new, not used, and assemble vehicle in the United States in 2025. And the last day to purchase the vehicle is December 31st, 2028. And it has to be a qualified passenger vehicle. And the Senate removed the EV tax credit of $7,500. So that's going to end on September 30th. So you're going to see a lot of car companies sending out, I think Tesla is one of them, saying that, oh, the federal tax credit is going to end on September 30th because you have to have that vehicle delivered to your house by that date in order for you to get that $7,500 tax credit. Okay. But anyway, you can write off up to $10,000 a year in interest, not the principal that you repay, but interest on qualifying auto loans. So you do not need to itemize your deductions to claim the auto loan deduction. However, it cannot be a refinance or a personal loan. So it has to be a car loan that you got from the dealership or from the bank on a new vehicle. Okay. And sorry to disappoint some of you guys, but ATVs, trailers, and campers are not eligible. All right. Again, you have to take out the loan between 2025 and 2028. For the phase out range, the income phase out range is actually a lot lower. So phase out begins at $100,000, and the deductible amount is reduced by $200 for each $1,000 of income above the threshold. So the difference is only $50,000 in this scenario. Let me change that to red here. Okay. So the income phase out beginning at 100,000, you do not get this car loan interest at all if you're a single person making over $150,000. Okay. So if you're making, let's say, $120,000 a year, to calculate the difference, again, you are $20,000 into the income phase out range, and you divide that by 50,000, right? That's the difference here. So you lose 40% or $4,000 in that total $10,000 deduction. So in this scenario, if you're single making $120,000 a year, you're only going to be able to deduct $6,000 in car loan interest. Not bad, but just keep that in mind. All right. If you're married, the phase out range begins at $200,000 in modified adjusted gross income. So that's also reduced by $200 for each $1,000 of income above the threshold. And that threshold is $250,000. Okay. Again, same thing. It's the difference of $50,000 that is the same as a single or head of household. So if you make $240,000 a year, you're going to lose 80% of the deduction. And so you got to subtract 8,000 from 10,000 maximum. So the only amount that you can deduct is $2,000 if you make $240,000 a year. Okay. So to remember, when you're looking at what car to purchase, it needs to be a final assembly has to be done in the United States. So if you get an imported car like a Mercedes or Volkswagen or I don't know, something else, like I'm not really a car guy, but those cars would not be eligible, right? I don't know about Honda or Toyota. You have to kind of look and see if they were assembled here, but then they are not American-made cars, so I doubt it. I doubt that you could write those off, even though those are probably the most reliable vehicles there are. But that's something that you definitely want to look into because it did not say in the bill on which brand is what, right? But I would imagine Ford, Chevy, any GM vehicles will be eligible for the tax deduction, but probably not for Honda or Toyota. Correct me if I'm wrong in the live chat, okay? Oh, man. Okay, so that's the car loan, and yeah, there we go. So I guess Aaron was already asking the question. So how do we know what cars qualify for this, right? So I would say, yeah, as I said, probably GMC. If Subaru, yeah, I'm really not a car guy, but it's anything that's assembled here. Tesla would qualify. Yeah, that's something that I would like to look into as well. Good question, though. Okay. All right. So the next one is going to be a health savings account. So the health savings account is it's a disappointing one. I'll say that from the House bill, they had a whole list of things. Okay, so in the final bill, this is the final bill. If you go to page 666, they have 3 sections. That's it. Originally, they had like about 10 sections with the extension or the expanded contribution and with the income phase out range, all that stuff. I talked about that in a previous video. It's really disappointing that we didn't get that in this bill. But section 71306 is the permanent extension of safe harbor for telehealth services. So that was already in the original TCJA. They just decided to make it permanent. But basically, it allows high deductible health plans to cover telehealth services without a deductible. Okay. And the next one was 71307, which is the allowance of bronze and catastrophic plans in connection with health savings account. So basically, it allows bronze and catastrophic health plans from the Affordable Care Act to be used in connection with a health savings account or HSA. And section 71308 allows patients enrolled in a high deductible health plan or HDHP with HSA to participate in direct primary care benefits and to pay directly or direct primary care fees from their HSAs. The House originally proposed, again, increasing health savings contributions to an additional $4,300 and $8,550 on top of the standard contribution limit for individuals with income of less than $100,000 and married couples with income of less than $200,000. And that provision was completely removed by the time it reached the Senate. And I'm very disappointed in the HSA provision being completely removed. The bill doesn't say anything about rolling over your FSA and HRA to your HSA. It doesn't say anything about permitting HSA contributions if your spouse has a health flexible spending arrangement, or FSA. And it also doesn't say anything about individuals enrolled in Medicare at the age of 65 to contribute to their HSAs. And that was a big one that I rooted for. I even wrote to Congress. I wrote a letter to Congress saying that we need to allow people on Medicare to be able to contribute to their HSAs because the healthcare expenses will keep going up and up and up. I'm really disappointed that didn't make it in there. And it also doesn't say anything about both spouses can contribute $1,000 in catch-up contributions when you're 55. So right now, it only allows one spouse in the HSA family plan to contribute the extra $1,000 if that spouse is 55 or older. Okay. And the IRS has already released the HSA contribution limits for 2026. For individuals, it's going to be $4,400. And for the family plan, it's going to be $8,750. So if you're 55 or older, you can still contribute the extra $1,000. But if you and your spouse are both 55 or older, you each need to have separate HDHPs with HSAs to contribute that extra $1,000. It's such a dumb rule. Okay. It's such an outdated rule because people didn't think about it too much, because when this happened, when HSA came out, it was during the Bush administration in 2004. And it wasn't really that big of a deal because the contribution limit was like $2,000 or something like that. And not a lot of people had the high deductible health plan. As times changed and they found the triple tax advantages that you get from the HSA, people are starting to invest in the HSA because it allows you to invest. So, it's just that I'll just say that I'm disappointed that the HSA was removed. And as far as Aaron's question about the HSA Modernization Act of 2025, as far as I know, that one is still active. I don't know if the Republicans will try to pass it. Just because it didn't make it to the big, beautiful bill, it doesn't mean that it's not going to happen, right? So the question of HSA Modernization Act, and if the House Republicans pass that and say, yeah, this is a good idea, because there was a huge traction to make that happen, make this act happen. And for some reason, they just removed the bill from the Senate, and I can't find any writing, any press release about the HSA, because my channel has been talking about the HSA a lot, and they haven't shown that at all, like why they removed it. So my hope is that they can just pass that individually and just say, all right, let's make this HSA benefits happen, because there's a huge bipartisan supporting on that. And I'm really hoping that that's going to happen. But really good question, Aaron. I really appreciate that. But yeah, this is one that I was really just disappointed on. But anyway, all right, next one. The Trump account. So if you have a baby on the way in 2025, congrats, by the way. I want you to pay attention to this. Oops, sorry about that. I want you to pay attention to this. And I'll make a dedicated video about this in the future, because the previous video that I did about 2 weeks ago, that was just what was in the proposal, and I want to make some updates on it. All right. So if your baby is born between January 1st, 2025, if you already had the baby 7 months ago, cool, and December 31st, 2028, your child is eligible for IRA style account, or also known as the Trump account. All right. So kids born before 2025 is not eligible for the $1,000 seed money. Okay. So if you have a child under 18, you can still open a Trump account at a bank of your choice. And the banks and brokers, they're still working on this. I haven't seen any products coming out that says Trump account. All right. But the parents can contribute up to $5,000 a year per child, and another $2,500 from the parent's employer. So the amount contributed by your employer will not count towards your taxable income. So that is sweet, right? And the money inside the Trump account will grow tax-free until it's withdrawn. So kind of like the Roth IRA, that you don't pay taxes on the dividend distributions or capital gains from investing in an ETF. The other restriction is that you have to invest in a diversified fund that tracks a U.S. stock index like the S&P 500 index fund. And it actually says that in the bill, I can't find the page number. It actually says it on there that the S&P 500 index fund. It doesn't say they have to invest in that. It just says that something that tracks that tracks the S&P 500 or something similar. Okay, so when the kids turn 18, you can make partial withdrawals, and you have full access to the amount for qualified expenses at age 25. So the money can be taken out penalty free for higher education expenses. And there's a penalty free, tax free, and then there's a not tax free. Sorry, there's a $10,000 exception for new home purchases. Okay, and so if your kid decides to buy a house and your kid could use that Trump account to put $10,000 towards the down payment of that home, and $5,000 can go towards a baby of their own. If you're going to become a grandparent one day, your your kid's child can put that $5,000 towards the baby. And once your kid turns 30 years old, you can use it for anything. So once it's cashed out, funds used for a qualifying purpose will be taxed as long-term capital gains tax rate that's a 0, 15, or 20%. Okay, so it's not a tax-free withdrawal, but it is a tax-free growth. So you don't pay taxes every year for dividend distributions or capital gains if you sell or whatever. But you do have to pay taxes on the gains, just the gains, not the principal that you put in, because that's an after-tax money. The gains that you get, you will pay taxes on. Okay. Did I have notes on that? I don't think I have notes on that. Okay. So let's say you put in over the course of 30 years, just use a small number here. I shouldn't say small number. 30 years, let's just say 100,000. All right. And then in there, you put in 100,000, and then you have an interest of 250,000, right? So that's a total of $350,000 total, right? So the capital gains tax you'll be taxed on 250,000, but you don't pay taxes on the $100,000 that you contributed or the employer contributions, as far as I'm concerned, right? So if you use it for qualified expense, and you will be taxed at 0, 15, or 20%, kind of like selling your stock, and if you held it for at least a year. But in this case, it's for qualifying expense. But if you use it for non-qualifying purpose, then you will be taxed up to 37% as an ordinary income tax on that portion only. Okay, so please keep that in mind. So the cost of the program will be about $3 billion a year, with 3.6 million babies being born in the US every year. So 3.6 million, $3 billion a year. And I'll make a separate video about this in the future when banks and brokers start offering the Trump account. But I do want you to check out that 529 video I did last week, because I still believe, as of right now, the 529 is probably more beneficial than this account. But if you're having a baby this year or in the next 3 years, then I would say the Trump account is more beneficial, because that $1,000 seed money is not something that you don't want to miss out on. Now, right now you're going to be like, $1,000, what's that? That's nothing, right? But if you go to wrong one. If you go to my website, just go to firesightshare.com/resources, and you get the financial independence checklist. If you want to, you can download that. But let's do some compound interest calculation. Okay. So let's say you're like, man, I am not putting any money into the Trump account, and I'm just going to leave it at 0. But I'm going to have that $1,000 in the seed money. Okay. So I'm going to do the annual, let's do an 8% average annual return for 30 years, because you got to wait until you're 30, your kid to turn 30 to have full access to that. All right. So if you do 30 years annually at 0, and just do $1,000, let's calculate that. So in 30 years, that's going to turn into $10,062.66 if you invest in a, let's say, S&P 500 index fund with an 8% average annual return, right? What if you did a full maximum? Let's say you're like, I'm loving this Trump account, and I'm going to put $1,000 well, $1,000 from the government, right? And I'm going to put $5,000 a year into this account because I want my child to succeed, and I want my child to be able to buy a home, buy a car, go to get some education, whatever. Okay, let's take a look. So that gives you, oh, look at that. In 30 years, your child would have $576,000. So right here on my website, it even shows you total principal is 151,000. The interest itself is 425,000. So obviously you don't want to take all that 425,000 out, but when the time comes, you want to be strategic about how much you want to withdraw, and you can teach your child about that because your child is going to have full control of that account. Um, you know, maybe do like a chunking strategy, right? Just take chunks out of the Trump account instead of taking everything out, but just educate your kid on that. But what if that's what if your employer also gives you that $2,500 to your child? So that's 7,500 a year. Calculate. Wow, look at that. In 30 years, that would be $859,000 by the time your child turns 30. So that could be pretty significant if you think about it. Just that $1,000 is $10,000 in 30 years, right? So that's something to really think about with the 8% average annual return, and set it up that way. So if you're having a baby this year, just open one up because the government is going to give you $1,000, right? And fundamentally, some people will say, well, great, taxpayers will have to pay these babies $1,000, and I get that. Like the country's already 37 trillion dollars in debt. I get the argument on that, but the other side of the equation is the government's argument is that we're just not having enough babies. I think the birth rate is, we're at a pace of going to like 2 workers to 1 retiree eventually. I can't remember the year, but there's a research on that, and that's why they're pushing this baby program. It's not a Trump thing too, and I never take sides on the political spectrum. I'm a registered independent, right? But this baby idea, if you remember baby bonds, that idea came out during the Obama administration and during Biden administration too. And if I remember correctly, the Republicans really opposed that idea, probably because the Democrats, it was their idea, and the Democrats opposed the Republicans' idea. It's just back and forth, kicking each other, right? So it's not is it a good idea? I don't know if it's going to encourage more people to have kids because of the $1,000, right? Because on the surface, people are going to be like, well, $1,000 is going to cost, that's going to be gone in like for whatever, because what am I going to do with that? Just invest in the kids. Some people may not find that attractive. And also childcare costs are still high, right? And some of the childcare costs could, it could be as high as your mortgage payment. I've seen it, Well, so glad my daughter's she's going to be a teenager in a month. And, it's just, I'm so glad that I'm not using any childcare services. All right. So the next one, what was the next one? Okay. Quickly, I'm going to talk about the federal employee pension. So in the bill, the only thing that made it to the bill was the auditing the federal employee health benefits program and to remove ineligible members. So what got taken out, the $350 filing fee for MSPB, that got taken out. New at-will employees to pay an additional 5% towards FERS, that got taken out. Charging an additional 10% FERS contributions towards non-at-will employees, that got taken out as well. And charging unions official time and the use of agency resources, that got taken out as well. So all of these back and forth from the House, Senate about the federal employee pension, that just completely got removed. But I think there's some news going on that the Supreme Court ruling on the federal employees, that's a separate subject that I can talk about in a separate video. But basically everything got taken out of that bill except for the FEHB for the auditing to remove all ineligible members. But as far as your retirement pension, the first pension contributions, high 3 is going to remain at high 3 average salary, and high 5 is not in there anymore. And if you're paying 0.8%, you're still going to be paying 0.8%. So there's that. Anyway, the next one is Oops. Sorry, I put my computer to sleep. I hope I'm still live streaming. Oof. I don't know how my computer went to sleep just now. There we go. That was weird. All right. The next one is, you know what? Let me answer some questions real quick. Okay. From the private group, who's Andre Jeek? I don't know who that is. Andre Jeek said mega backdoor Roth and backdoor Roth IRA were removed. Who's Andre Jeek? I don't know who that is. No, that was backdoor Roth IRA and the mega backdoor Roth. They were not in the bill. I don't know who that person is, but um, the uh, wait, backdoor Roth IRA, is that what you're asking? Okay. Backdoor Roth IRA was not in the bill. You can still do it. You can still backdoor your Roth IRA. You can still do the mega backdoor Roth. Hang on. I don't know who that is. Is that a YouTuber? I did not see that in the. Oh yeah, I've seen this guy before. Okay, hold on. I'm not. I've seen this guy before, but I don't believe. What timestamp? 8:11. Oh, I see it. Okay. Let me see. I don't want to share too much because I don't want to get copyright strike, and I'm not trying to take his content or anything like that. Is this the guy you're talking about? Okay. That is not correct. Um,
IRA and then convert it to a Roth. A lot of people I know do this, and it's totally legal, but not for a lot longer. Because
no. So you can still do the backdoor Roth IRA this year. You can still do the mega backdoor Roth. No, that is not correct. And yeah, that was not in there. So I'll explain the backdoor Roth IRA later on, but nope, that is not in there. How do I know? I read all 870 pages of them. So that's not in there. Okay. Good question, though. It scared me for a second. I was like, did I miss that? The backdoor Roth IRA and the mega backdoor Roth? I'm like, I did not see that in there. But no. Okay. I agree. I hate car loans, Harry. I don't. I buy cars with cash. I am so anti car loan because people don't account for the depreciation rate. And is this going to encourage more people to buy an expensive car? Not necessarily, but people will look at it as, oh, I can just write off $10,000. But then, like, that's not $10,000 tax credit; it's $10,000 in tax deduction. So you're not going to get all $10,000 written off from the interest, thinking that, oh, you're going to save money on your car loan and interest rate on your car loan. Yes, I can definitely see people mistaking this as oh yeah, we're going to have, I'm going to buy a $40,000 vehicle with a 9% interest, and I'm going to be paying, what is that? Let's say $5,000 a year on interest. Now I don't have to pay $5,000 in interest. That's not it at all. If your tax rate, it's at 22%, it's 22% of the $7,000 or whatever that interest that you can get. That's the difference between the tax credit and the tax deduction. So yeah, it's I'm really hoping that people understand that. But yeah, I'm hoping that they'll watch my videos. Probably won't. So the benefit to this is that you can trade in the accounts. I'm not sure what this question is pertaining to, but that's all right. Okay. Cool. And all right, the next one is going to be a quick one. This is going to be the child tax credit. That's going to be on page 221. And child tax credit is being increased from 2,000 to 2,200. This is the child tax credit. Okay. So the amount will also be adjusted by inflation annually. So the maximum refundable amount is $1,700 per dependent. So there's the income limit of $200,000 a year in modified adjusted gross income if you're a single individual, or $400,000 a year if you're a married couple filing taxes jointly. So the child tax credit is reduced by $50 for each $1,000 of income above the income threshold. So if your income is $244,000 a year as a single individual, you do not get the child tax credits at all. And if your income is above $444,000 as a married couple, you do not get the child tax credits at all. And if you're in between those income ranges, then you can get a prorated child tax credit. Okay, I hope that makes sense. And just remember that a tax credit is different from a tax deduction. I've been saying this throughout this live stream. Okay, so let's see, do notes here. A child tax credit. Okay, so if you have 2,200, let me use a different pen. Okay. Let's say you're going to get 2,200 back. That's a child tax credit. All right. And let's say you owe $5,000 in taxes. Okay. Then you're only going to owe $2,800 because that $2,200 can directly reduce your tax bill from $5,000. So if you owe $5,000 in taxes this year, you're only going to owe $2,800. That makes sense? Okay. A tax deduction, on the other hand, like the SALT deduction, is different. And let's say you get the full $40,000 in SALT deductions in 2025, and your marginal federal tax rate is 24%. Then you want to multiply 40,000 by 24%, and that'll give you the tax savings of $9,600, right? So let's do a smaller number. Let's say you do, with a different pen, let's say you do $20,000 multiplied by 24%. So you actually save $4,800. So this matters as far as what that marginal tax rate is going to be. So keep that in mind, that this is your marginal tax rate at the federal income tax level. So 24% of $2,000. Okay. That's where you want to figure out. But the tax credit is directly going to deduct from the total taxes owed. So the tax deduction reduces your taxable income, while a tax credit would directly reduce your tax bill. I hope that makes sense. Okay. And the next one I want to talk about, and talk about it just a little bit ago, SALT deduction. This has been on the news for a long time, and everybody argued why we need to have SALT deductions. Okay. So if you don't know what a SALT deduction is, it stands for state and local tax deduction. So it basically allows taxpayers to deduct state and local income and property taxes on their federal tax return. So it became a big debate in 2017 when the Tax Cuts and Jobs Act, or TCJA, capped SALT at $10,000, which impacted people living in high tax states like California, New York, New Jersey, and Illinois, right? So as a result, it just basically became a blue state versus red state issue, because high tax states were, they were disproportionately affected by the SALT deduction limit of $10,000 in 2018. So during the Big Beautiful Bill debate, many House Republicans in those high tax states were going to vote no on the bill, on the Big Beautiful Bill, because they saw that how the SALT deduction as a more of a necessity for the people in their states. So the House Republicans in those high tax states like New York and California they were just going to say, no, I'm not going to vote on this. And they needed those votes, right? And other House Republicans in red states believe that it forced their constituents to subsidize those in blue states, and that's why it was constantly on the news between those debates. Does the SALT deduction impact someone like me living in the state of Nevada? Yes, it does, sort of, but not really, right? Because I don't have a state income tax in Nevada, and my property tax is very low. But some people argue that low income tax states should not help other states because they chose to pay higher taxes by living there. And I'll let you guys argue that in the comment section down below. So the big beautiful bill has the SALT deductions capped at $40,000 in the calendar year 2025. In 2026, the amount increases to 40,400 due to a 1% annual inflation adjustment that will remain in effect through 2029. So starting in 2029, it goes back to the $10,000 SALT deduction limit. And that's a problem for another day that they can figure out. So in order to claim the SALT deduction, taxpayers have to choose to itemize their deductions on their federal tax return rather than taking the standard deduction. Okay. So, sorry. So, the standard deduction already, we talked about that in the beginning of this live stream. It changed from 15,000 to 15,750 for single individuals and 30,000 to 31,500 for married couples filing their taxes jointly. So if your itemized deductions will either exceed $15,750 or 31,500, then including the SALT deduction could be more advantageous than the standard deduction. Okay. And I'm going to break that down for you. Hold on. My throat is killing me, so to speak. All right. And the SALT deduction allows you to deduct a combined total of either state and local income taxes or state and local tax rates, sales taxes. Okay. So in addition to state and local property taxes. So let me just break this down real quick. Okay, so back to the standard deduction. No, you know what? Let me just go to the new one. So if you can combine for the SALT deduction here. Okay, so you can combine either state, local income taxes, plus property tax, okay? Or you can do state, local sales tax plus property taxes. Okay. So you cannot deduct both state and local income and sales taxes in the same year. That makes sense so far, right? So for someone like me living in the state of Nevada, it would make sense to itemize my sales tax and property tax because I don't have to pay any state income tax, right? But if you're in a high tax state like California and New York, then you can choose either or, just not a combination of both. But one common thing that you'll see is the property tax here, right? And I'm sure you guys know, or if you're watching this from New Jersey, just you're probably paying like a lot of property tax, but it really depends on your mortgage too. But anyway, the income phase out range, it does start at $500,000 in modified adjusted gross income. So the income threshold is really high. So in 2026, that income phase out range does get adjusted by inflation from 500,000 to 505,000. And the way the bill was written is that your SALT deduction can be reduced by 30% of the income threshold that you exceed. So let me give you some example. Okay. Is this better? Hold on. Okay. So let me give you some example here. Let me scroll down. There we go. So if you make, let's say it's a good problem to have. Let's say you make $550,000 a year. Okay, that's your income, which means that you are $50,000 in the threshold above, inside the income threshold for the SALT deduction, right? Okay. So if you multiply 30%, 50,000. So the income threshold that you exceeded, remember, it's $500,000 cap limit. So you multiply that by 30%. Solve it for me. There we go. So now it's $15,000. So the maximum SALT deduction that you could claim is $25,000 instead of $40,000 because you do 40,000 minus 15,000. It's going to solve it for me. It's 25,000. So you cannot claim the entire $40,000 if your income is $550,000. It doesn't matter if you're single or married, filing jointly, but $25,000 is all you can deduct out of that $40,000. Okay, I hope that makes sense. Let me change it to red. So you got to deduct 15,000 based on the 30% calculation. That's all in the bill too. Okay, so yeah, but you can only hold on. Yeah, that's right. Okay, so if your income is 600,000, okay, and then you multiply 100,000 above that income threshold, multiply by 30%, and that's going to give you, oh man, $30,000, right? So you have to subtract 40,000. I'm sorry, subtract 30,000 from 40,000. So the maximum that you can deduct is $10,000. All right. I hope that makes sense about the income phase out range. And if you think this largely benefit the wealthy people, you're actually not wrong. And I'm not trying to start a political debate, but I'll just show you the math here. Okay. So with the new $40,000 SALT cap, it means that itemizing your deductions would make sense if you have larger mortgages. And who qualifies for the larger mortgages? Typically the higher income people, right? So if you're a homeowner who itemizes your deductions, you can take advantage of the mortgage interest deduction, which is the first $750,000 of a mortgage. And that rule is unchanged from the original TCJA. So the big beautiful bill added the mortgage insurance premium deduction, which treats premium payments as a form of mortgage interest. So that's for the people who put down less than a 20% conventional down or 20% down payment for a conventional loan on their home purchase, who will have to carry mortgage interest until they reach 20% equity in their home. Okay. So not to mention how the mortgage interest rates are still higher than what they used to be from 2020 to 2021. So let's say, let me pull up I should have a mortgage calculator. I do. Okay. So let's say you took out a $500,000 loan. All right. I'm not going to put any down payment on it, just a $500,000 loan. And interest rate right now, it's about 6.5% for 30 years. And the first year, you're going to pay about, let's say, how much? Yeah. So you're going to pay about $29,600 in mortgage interest. And that's pretty close to the standard deduction of $31,500 if you're filing jointly, but you already exceed the $15,750 standard deduction if you're single. But if you took out a $300,000 mortgage, and let me go to that, and let me change that to $300,000. Okay, so if you took out $300,000 in mortgage for a 6.5% interest rate for 30 years, the interest payment for the first year is about $14,000. And that's enough for single individuals to itemize the deductions. So what if you have another $10,000 in state income tax? Then you could benefit from the SALT deductions by itemizing everything, right? Just keep in mind that it is a pain in the butt to itemize your deductions. It really is. For someone like me, living in Nevada, in Vegas, I tracked all the sales tax. We don't have state income tax. So I have to, I have all the receipts. I scan them in, put them in Dropbox. If you don't have Dropbox, check it out because that's where I store all my receipts. And it's such a pain in the butt to keep track of those. But what I want you to look at is if you're looking to buy a house, and I understand that the interest rates are high, home prices are still high, right? But just by looking at what the interest is going to do in the first 5 years, and if you're looking to itemize your stuff, talk to your CPA, okay? And just say, maybe this makes sense because now I can write off that interest from the mortgage. And that could save you some pretty significant money if you're in a, especially if you're in a higher marginal tax rate. But just keep in mind that as years go by, the interest payments, this is kind of accumulating interest, but this interest payments right here in the middle, this is going to increase throughout the years. So as your interest payments decrease, you may not be able to reach that standard deduction limit because the standard deduction is always going to increase by inflation every single year. So the standard deduction, again, for married, if you're married, is $31,500. But I bet you next year it's going to go to 32,000, maybe 32,250. But so if your interest payments, when your interest payments go down, you may not be able to meet that, and then eventually you're going to have to just go to the standard deduction instead of itemizing them. So I hope that makes sense. Just kind of how you want to make that decision on. I don't want you to buy a house, a $700,000 house, because you're like, oh, I'm going to write off my mortgage interest. It's not how it works. My rule has always been the same. Never more than 25% of your gross income towards your mortgage payment. If you make less than $75,000 a year, you're not in a business of buying a $700,000 home, right? Especially with a 6.5% interest. It doesn't make sense for you to write that off. I hope that makes sense. You have to prioritize your mortgage payment to make sure that you can afford it first, and then think about how you can itemize your deductions. That should be the order, all right? I hope that makes sense. Yeah, just the fact that I have to explain that, kind of wild. Anyway, let me go to another question. Hey, what's up, man? Yeah, if you're interested in joining my private group, this is being live streamed to the private group right now. You go to firesuch.com/community, and there's a coupon code that is live right now. Let me go look. It is called free live stream. That is the coupon code, and I'll put that in there. If you want to get 20% off to join my private group, free live stream. There we go. Do that, and there's a banner. You can get your free resources, firesuch.com/resources on there. Oh, that's a good question. Why do I choose 529 over the Trump account? Well, I mean, my daughter is going to be 13, so she's not going to be eligible for the seed money. I am going to open that account for my daughter, the Trump account, and just to see how it goes. And I want to kind of see the process. I know how it is, how it's tax structured, but she still has a 529 plan, and as I still think that is more beneficial in her scenario right now. And she also got some like GI Bill to go to school and all that. I transferred my GI Bill over to her over 7 years ago, something like that. But 529 is pretty good because the Trump account doesn't say anything about rolling that over to the Roth IRA, but you can with the 529. So if you're here, let me see if I can do a better pen. Yeah, that's pretty good. Okay, so is there any way to make it draw with finger? No. Okay. So the 529 account to Roth IRA thing, that came out back in 2022, but it did not take effect until 2024. Okay. And there are a lot of restrictions to it, but I still enjoy this 529 for my daughter. And the maximum lifetime limit that you can roll over is actually $35,000. So $35,000 is the lifetime limit for the 529 to the Roth IRA for your kid. So this has to be for your kid. So your kids, 5 Roth IRA. So the beneficiary name has to match, right? So if the 529, you have a 529 for a kid one, that means you cannot put that over to kid number two for the Roth IRA. They have to match. It has to be kid number one to the kid number one, right? It does, when you make this rollover, it is subject to a contribution limit for the Roth IRA. So, we'll see how that goes, what the Roth IRA contribution limit will be in 15 years. But your child also has to work. So, because it does count towards the contribution limit. So you cannot roll over the entire $35,000 to your Roth IRA at once, because I'll use this year, for example, right? So the maximum that you can put into your Roth IRA this year under the age of 50 is $7,000 to the Roth IRA. So let's say your kid is 22 years old and just just finished college, and you have $30,000 left over. Okay, so I'm gonna change that to 30,000. You have $30,000 left over in your 529, and you're like, you know what? I want to help my kid fund their retirement so they can use that money on something else, saving for a house or something like that. Okay, so you got to remember that 529 has to be maintained for the beneficiary for at least 15 years. So if your kid finishes college at 22, but you've only had that 529 open for the last 10 years, you still got to wait another 5 years to make that rollover. But it's still, it can still grow, right? That's the beauty of the 529. The amount that you roll over has to be from contributions made to the 529 account at least 5 years prior to the transfer date. So not any money you contributed in the past 5 years. Interest earned, fine, but contributions, no, not for the past 5 years. So if you've had it open for 15 years, you can move money from the first 10 years of your contributions, interest earnings, but you have to, the contributions from the first 10 years, and then move it over to the new kids account for the Roth IRA. I hope that makes sense. Okay. So let's say you've done that. You've had it open for 15 years, and your kid's 22 years old. Okay. And you've had the 529 open for, let's say, 20 years, and you have no contributions in the last 5 years. So in 2025, you can contribute $7,000. And then next year, you can do the same thing, 7K. Okay. That's 2027, 2028, and then 2029. So 7K, and then what is that? 2K. All right. So the final year will be $2,000. But you have to remember that your kid has to work, so that your kid has to work and makes at least $7,000 a year. Okay. $7,000 a year to be able to roll that over to your kid's Roth IRA, so that $30,000 rollover, once that's done, that's it. That is the lifetime limit that you can roll over. So that $30,000 in Roth IRA in 40 years could turn into $450,000. That's pretty sweet. And if your kid maxes out their Roth IRA every single year for the next 40 years with an initial $30,000 that you have, and if I adjust by inflation with 2% annually, that's going to be $4.6 million in tax-free money. That's 8% average annual return if your kid invests in just the S&P 500 or something similar, right? So is this going to help your kid tremendously if you just put that money from 529 to the Roth IRA? Absolutely. You can do whatever you want. I mean, if you're like, my kid has enough, I don't need to gift him any more money. You can actually change your 529 beneficiary when you're all done with the kid back to yourself. So you can make yourself the beneficiary when you're done with the kid, or you can transfer it to kid number two. Okay. You can even give it to your in-laws. It just has to be anyone in your family tree, because the laws are pretty wide open when it comes to the family tree on who you can change it to or whatnot. But yeah, it's very beneficial. I'm still gonna have a Trump account for my daughter. And when I open that, I'll make a video about it. She's still going to have a 529 account. She still has my GI Bill from my Air Force days. and she's still going to have several other investment accounts. But the key here, educate your kid, right? Like, don't just give them the money and say, hey, here's 50 grand, go figure it out, right? Don't just teach them about investments. They're going to be bored with that really fast. They're going to be like, I don't really care. But when it comes to spending money and saving money, that's really the key. The concept of money, it takes time. And I've been teaching my daughter about spending and saving, just the mentality of that since she was 7. And she has a Chase debit card. Chase has a kids account for it's like only debit card, and then they can see how much money they save and all that. She's been doing that. She's been saving money. She's been doing chores or whatnot, all that stuff. And when she goes to Target, or she goes to whatever stores, and she looks at the item and it says it's $4.99, and she's like, nope, that's going to be like $5.20 because of sales tax, that kind of thing. So financial education, kind of like what I've been doing for the past 4 years on this channel. It's that's more important than anything else, because I can just tell you, hey, why don't you just invest $10,000 a year? That's it. Cool. Yeah, I can do that, but why? Right? The why matters. The how matters too, but you have to understand the reason behind it and how these numbers work. So, but yeah, anyway, I gotta go pack. I really appreciate all of the questions you guys sent in, and as well as the private community. But just check it out at firesightshare.com/community. And if you want to schedule a 60-minute session with me, you can go to firesightshare.com/consultation. I just don't have any schedules open until end of July. We're pretty packed at this moment. And I'm also going on a cruise in a bit, and to go enjoy Alaska. If you've been to Alaska, let me know in the comment section down below. Yes. Oh, just real quick, let me answer this last question from Jesus. Can I open a 529 under my name and then transfer it to my son if he decides to go to college? Yes, you can. But just remember that 15-year rule still applies, right? If you held it under your name for the next 15 years, he goes to college, and then you want to transfer the rest to his Roth IRA. Now you got to wait another 15 years to make that happen. It doesn't hurt to just keep it under his name, because you're always going to be the custodian. It's not a UTMA account, UPMA account, or UGMA where your kid takes possession of that money when they turn 18 or 21. 529, you're going to own that forever. You're going to be the custodian for it forever. You can always change the beneficiary whenever you want. So that's a really good question. But appreciate the question. I'm going to go pack, and I'll be back in 2 weeks to do another live stream. But in the meantime, check out all the videos that I have on my channel and on the playlist if you want to know more about financial independence strategies. All right. Until next time.